Hello, everybody. Welcome to TrendSpider Live. My name is Mike, and today is a very important day for the markets because we're going to be watching for the FOMC rate decision. It's going to be live in just 7 minutes. So I started the live 7 minutes early just so we can get, situated and everyone can say what's up. If you're in the chat, go ahead and say hi. Who's out there? Where are you guys from? Glad to have everybody tuning in because this is going to be a very fun time, I think. We'll see what happens with the FOMC rate decision. It is priced in for there to be a 25 basis point cut. As you can see here on the poly market indicator, let me pull it up on the daily chart. This is basically taking live poly market betting odds and putting them right here on our TrendSpider chart. And it's clearly showing that the odds of a 25 basis points decrease, a rate cut essentially, has been only climbing pretty much ever since like August 4th and that sell-off right there. So hello, everybody. Hello from Israel, from UK. Thank you, everybody, for joining in. Columbus, love to see it. We got people from all over the place. So thank you guys all for tuning in. And so first thing I want to do here is actually go ahead and ask our little sidekick AI a question about the FOMC. I'm just going to say the FOMC rate decision is today in just a few minutes. Let me send this in now. And I'm just asking, what should traders and investors be watching out for ahead of this decision, and then give a bull and a bear case for a 25 basis point cut, since that is probably what is going to happen. We have about an over 90% chance of a 25 basis point cut. By the way, if you guys aren't subscribed to the TrendSpider channel, please go ahead and do that now. That way you don't miss out on any future lives, and you can get notifications for anytime we go live and every time we post videos. We post tons of free, awesome content for you guys. Follow us on X, Twitter, all that stuff, because we provide tons of value for you guys for free. So please go ahead and press the like button, subscribe if you aren't already. But let's take a look at what our sidekick has to say. It says FOMC decision is indeed imminent. Of course, here are things to watch. Bond yields, that is a very smart one. Something I'll be definitely watching today is TLT, which is bonds. The dollar strength, DXY for sure, and VIX, of course. VIX, let's take a look at, let's just pull up VXX for now so you get it for sure in real time. See how volatility is looking going into the event. It looks like it's right now, it's surprisingly coming down. Popped up, peaked at around 12:55 Eastern, and now it's actually came down right before, which is kind of interesting because we have the decision here in 4 minutes. Welcome, everybody. The model I'm using for Sidekick is Claude. I always use Claude. I think Claude is the best for it. More people in Columbus, awesome. Massachusetts, and thank you guys for joining. Where do you watch Powell have a speech? I'm going to be streaming it live right here. So just stay tuned in, and I'll stream Powell live. So yeah, I'll get it all live for you guys right here. But real quick, I want to see what else we're looking at here. Fed communication, definitely a very important thing is the dot plot, which is essentially a chart that the Fed releases every time they have an FOMC that essentially gives their projections for what the rates are going to be going forward. You see future rate path projections, very important because that is almost like forward guidance in earnings. It's the forward-looking statement for future rates and what they think it's going to be looking like. So very important there. And then of course is press conference tone, whether he's, hawkish or dovish. And let's see what the bull and bear case for a cut is. So a bull case for a 25 basis point cut is what we're probably going to get. It says inflation trending towards 2%, which it kind of is. Still in that 2 to 3% range, closer to 3%, depending on which one you look at. Labor market showing signs of cooling. Global central banks already cutting rates. Preemptive easing could prevent economic slowdown. from becoming recession. That's true. Market impact, equities could rally, dollar weekend. Let's see the bear case, because everyone kind of knows the bull case. That's kind of the thing about rate cuts is they are theoretically bullish for equity because it's easier to borrow or cheaper to borrow money, especially for small caps that aren't profitable. But the bear case, it says may signal Fed sees more economic weakness than markets realize. Yeah, that's the thing. When you're cutting rates, it generally means the economy is not doing well, which obviously is not a good thing. And then, yeah, with inflation where it's at in the 2 to 3% range, it's still closer to 3%. So in that sense, I don't think we really need a rate cut, but I think what the rate cut is coming from is pressure from the president, from President Trump, and then also, just political pressure. But let's see what else is coming here. Removes policy ammunition for genuine crisis. That's true. Market already priced in the cut. This is kind of what I'm thinking. The market already priced in the cut. And I think that's what a lot of people are probably thinking is the markets have already rallied. And we got 1 minute, by the way, guys. So let's open our news widget here. See if we can, market is absolutely ripping right now. By the way, if you see the SPY here on my chart, market is absolutely ripping. Let's see. SPY just went up. Yeah, it wasn't that crazy. It's 0.3%. It looks really good. This is the 5-minute chart, by the way. But yeah, I mean, everyone's expecting the rate cut, 25 basis points. So let's see what happens. Obviously, the market is liking something right now. The market is liking something. I'm just waiting for this news to roll onto the tape here. Yep. Yeah, it's a cut by 7 or 25 basis points. Our X team just tweeted it. So if you don't follow us on Twitter, go ahead and follow us because we're probably one of the first people that posted it. Honestly, that was really quick. But yeah, the rates were cut by 25 basis points and the market has ripped on that news. So very, very cool stuff. But this was pretty much priced in, you guys. I don't think this is what everyone came here for. Everyone came here to watch Chair Powell give a speech, and we'll see if he's hawkish or dovish and what he's saying about rate cuts going forward. So keep tuning in, and we'll go ahead and put that live once Powell is actually speaking, because that will be the real tell of what is going on. Let me pull up their YouTube channel just to get it ready. Yeah, they have a live ready to go
while promoting local community development.
Oh, sorry about that. Let me get this actually ready to go. I don't know what they're doing here, but they got something going on, the Fed. So once that goes live, I'll turn on the audio and we'll listen to what Mr. Powell has to say. Ready for big crash, someone says. So what are you guys all looking at now that it is confirmed that there was a 25 basis points cut? What are you guys looking at? What I'm going to actually take a look at right now is the dot plot. Let me go ahead and try to pull it up. And then also something else I wanted to show you guys is the fact that you can actually see the effective federal funds rate on TrendSpider. It uses the official Fed data. Very, very cool. So as you can see here, the last time we cut rates was not very long ago. It was actually pretty much exactly a year ago today. And since then, that was at SPY 558, give or take. Pretty good. We went up pretty much the whole time they were cutting rates. And then after the rate cut cycle, we tanked on, I believe that was the tariff news kind of sell off there. So last time we were cutting rates, markets went up. We're going up right now as we speak. Pull back up the 15-minute. Yeah, markets are loving this. Let's just keep it on the 5-minute for a little bit because markets are absolutely ripping up right now. I was going to analyze what happened historically, but I mean, look at what is going on right now. This looks pretty nice, pretty nice. Let's turn on our combined RSI ensemble. And as you can see on the 5-minute, which is, a really short time frame, of course, but we're getting 3 different RSI lengths that are overbought. indicated by the red candle. I'm using the combined RSI ensemble indicator. If you guys do not have that indicator, I'll put a link for it in the chat right now. It is a very nice indicator because you basically do not even have to put on the RSI onto your chart. So there's a link for it down there. And again, if you guys are still just tuning in, please go ahead and subscribe and like this video so we can keep bringing you guys this free content going live for FOMCs. TrendSpider is a paid tool. However, we just released a sale based on one of the videos that I just pushed live for the turtle trader strategy. If you guys haven't seen that video, go to our YouTube channel after you subscribe and watch our most latest video called From 5K to 100 Million. That is the turtle traders video. It explains the turtle trader strategy. If you haven't heard of it, it's a very cool story. It's a bunch of futures traders back in the 90s or 80s, I believe, that basically turned a little money into a lot of money. 5K to over 100 million trading futures. And I just dropped a link for a discount on TrendSpider. It's going to give you 50% off right there. It's in the chat. It's just trendspider.cc/turtle discount. So you can watch the video, import the turtle trading strategy and indicator. I'll actually show you guys it real quick. It looks pretty cool on the chart. But SPY is actually ripping right now, which is very, very nice to see. Hold on, let me turn off the combined RSI ensemble indicator. But it plots their strategy, gives you entries and exits, stop losses, everything you need right here in a single indicator. If you've ever heard of the turtle trader strategy, this is a very, very interesting and a cool tool to use. You can back test with it and all that cool stuff. Yeah, the decision is out. It's a 25 basis point cut. Let's check out gold. Yeah, someone mentioned gold. Oh, gold had a crazy 5-minute candle there. That is insane. Not sure what that was about. But the daily on gold, you can see it's still playing out from this breakout very nicely from like 317, at least on the GLD ETF. It had a very high volume breakout. And gold has been doing incredibly well. Let's pull up TLT. TLT is moving up right now pretty nicely. It's its bonds doesn't move a ton, but it's up 0.5%. We'll take that. We'll take that. Yeah, I don't know. We'll probably see a roller coaster. Yeah, Garrett, as we start getting the FOMs, or as Powell starts speaking. As you can see, QQQ has already given back most of its gains that it just gave off from the decision. It went up 0.3%, and it's pretty much given back. Look at that. It's given back pretty much all of the gains. So yeah, we're probably going to see a lot of volatility, you guys. Let's see what volatility is doing with VXX. VXX tanked really hard on that news, which is kind of expected since the news was out. And, people weren't going to be surprised about what's going on anymore. And then now it's slowly ticking up. Let's check out what small caps are doing on the IWM. IWM is looking incredible. Probably the best one that I've seen on the chart so far. Yeah, by far, it's up 1.31%, and it's not selling off nearly as hard. IWM is doing very, very well. On the social tickers list right here, we have Open. Open has been flying up recently. It's up 11% today. We also have Up, also been kind of a high-flying ticker. It came down from, its most recent surge there, and it's starting to base. That's an interesting one. It's also up 8% today. We got Lucid trending up. Curious what Tesla is doing at the moment. Tesla really pretty much just had like sort of a higher low breakout here, which is really known as like the VCP pattern, which we also have a video on that as well. You can go visit our YouTube channel if you want to learn more about the VCP pattern. But essentially what it is just making higher lows here. You got this base declining volume, and then boom, this nice high volume breakout right here. And that is exactly what Tesla is doing right now. Pretty nice looking chart. You can see it was squeezing in this kind of triangle formation for quite a while. So nice to see that. Let's check out what NVIDIA is doing. NVIDIA is coming down. NVIDIA is not looking too good. Let's check out the semiconductors in general. Semiconductors still holding up pretty nice, but NVIDIA is down. Someone said check out silver. Let's look at SLV. SLV is looking pretty good, similar to gold. Probably not at, well, I don't know, it's still looking really good. Still looking really good on SLV there. AV Go, we had an earnings live for them not too long ago. They're doing, yeah, they have that huge power gap, this earnings power gap up. And now, yeah, they're down pretty good today, actually. That's like a solid 5%. So yeah, pretty good move there. Let's pull it back to the SPY though. We do have Powell speaking in about 20 minutes. So curious what else you guys are watching. Yeah, we'll pull up AMD. What's AMD doing here? AMD kind of same thing as the market popped up and right back down, gave back all of its gains. Let's see. On the daily and weekly, now it's kind of trading at the higher end of its range right now. It's trading at this previous sort of resistance right there. So yeah, we'll see what happens there. Made this peak. It has a lot of resistance. So I don't know. Whoops, I meant to delete that. So AMD is an interesting one here for two. But yeah, on the intraday chart on the 5-minute, it's just everything looks like just went up and is just coming right back down, you guys. SPY, yeah, lots of volume on these two candles right here as the 25 basis point cut came in. If you guys missed that. So yeah, 25 basis point cut. And we're all waiting around to see what Powell is going to say here in 20 minutes. I have the stream ready to go right here. Once Powell goes live, we'll be able to stream it and hear it, listen to it together, see what he has to say. Let's see. Let's pull up TLT, see what rates are doing. TLT is looking great on the intraday chart. Obviously, a longer time frame you can see right here. Broke out of this kind of a trend line. Is that from the weekly? Yeah. Yeah, kind of interesting. Rates have, or the bonds have been really beat down lately. And theoretically, it's moving how it's supposed to be because bonds, aka TLT, and all these bond funds are inverse to rates. So if rates are going down, TLT should be going up, which is exactly what it is doing. It has two gaps up, which is kind of wild. And today it's just continuing to push higher. December 18th. Yeah, we can actually pull up the effective federal funds rate here on TrendSpider using the FRED indicator. Yeah. So right here, December 18th. I think that's what you said. Yeah, Kevin. Yep. See right here, TLT did indeed have a pretty nasty candle down. Check out this one. This one had a pretty big candle up and then came back down. And this first rate cut here was, so yeah, the first rate cut back in, oh, not the first rate cut, but the first one that happened a year ago in September literally marked the absolute top, or the recent top on TLT right here, which is kind of the classic sell the news event on TLT and bonds. Yeah, I'm going to be streaming Powell live right here. Right here. I already have it pulled up. It's on the official FOMC, or the Federal Reserve website. And once it goes live, we're going to hear it. I'll turn on the volume and we'll be good to go. Let's see. SPY is almost entirely reversed. The coaster continues. Yeah. Pretty crazy intraday moves right here, you guys. Let me pull up a couple things. For one, I know we're looking at the combined RSI ensemble indicator earlier. Look at that. These three different RSI links marking overbought actually did mark the top there on SPY pretty accurately. If I pull up the relative, yeah, the relative strength index. I'll just use the RSI divergence indicator. Oh no, not the candle one. This one right here. Look at that. When this RSI popped up, you can see the candle turned red. I'm just showing you guys the RSI so you can see it. Got up to like 80, 81 or so, a little bit over 81. And that really marked the top there on SPY. Let's see. RSI was pretty oversold here on the 5-minute. Towards the bottom at 658, which is right down where we're back heading to. So yeah, it's a very, very interesting time to trade. I personally do not trade times like this. It is a little bit too crazy for me. I'm also not much of a day trader anyway. But if you pull up the daily chart of SPY, you actually see there was some bearish divergence happening here as SPY made a higher high, but the RSI made a lower high. But we did kind of continue up after that. But right now, SPY, I mean, is very close to all-time highs. It's just 0.5% lower, basically, from the all-time high. So I don't know. What are you guys expecting when Powell comes up here? Are you guys expecting some sort of a pullback? Are you expecting the market to go up and then we get a pullback here in a couple of weeks? But yeah, SPY is dropping pretty hard on good volume right now, you guys. Let me pull up the 1 minute because this is honestly insane. I mean, look at the volume ever since this was obviously the rate decision. Volume even came in 1 minute before the rate decision where they decided to cut rates. But I'm curious to hear what you guys are thinking is going to happen as Powell comes up and, within the next few weeks or so. Let's pull up Sidekick and maybe we can get another opinion. I'm going to use Claude 4, but I'm going to use the Wall Street Dominator this time. I'm going to say the Fed just cut rates by 25 basis points. What do you think is the bull and bear case going forward based on what has happened in the past? Will it be a sell the news event, or will the markets continue higher even though we are at all-time highs nearly? Give your thoughts on what will happen to SPY, TLT, GLD. What am I missing? IWM. I just like doing these prompts, you guys, asking Sidekick because it has so much financial data that it pulls from. And it really just makes you guys, it gives you guys a lot of perspectives that you maybe wouldn't have thought of initially without it. And then, yeah, you just paste the prompt in. Everybody that has TrendSpider can use this Sidekick. So it's definitely worth using. If you guys haven't checked it out yet, you just click the bottom at the top right of your platform right here, click Sidekick. And it's basically if you connected tons of financial data, real-time financial data to ChatGPT. And yeah, that's basically what it is. And it's very accurate. It does not use the internet, which is a great thing because it doesn't hallucinate. It only pulls from real fundamental data, financial data that we have here on the platform that we pay good money for. It's good data, So the Fed delivered exactly what was priced in, 25 basis point cut. Rate cut fuel. With the Fed, we're looking at easier money conditions. Small caps already showing they love it, up over 10% from August lows. Yeah, IWM, the small caps have been doing very good. Let's check out what the small caps are doing right now. So small caps have been holding up the best, but they still did come down from the initial pump, and they are still coming down a little bit right now. Let's see what else we got. It looks like there's some unusual options flow on SPY. You got some October 3rd calls being bought, close to $2 million in premium. Bear case, again, sell the news vibes, valuations at nosebleed levels, depending on what you're looking at, of course. It's saying TLT might be rallying now, which is highly debatable. I mean, rallying now in this moment, but it says if inflation stays sticky and the Fed has to pause the cuts, bond yields could shoot back up, which means bond goes down and murder grows stocks. So that is interesting. Let's see. TQQQ calls. Yeah, I mean, the Wall Street dominator here is saying bullish, at least for the short term, it looks like. Let's pull back up the SPY. Pull back up the SPY here. Yeah, so really, it literally is a roller coaster. We've gone up, we came down. It's not a crazy range. We came up 0.38%, and then we're now down about 0.7% from the top. And I wouldn't say we're consolidating now, but it looks like we're going to start pushing back up potentially into Powell's speech. It'll be very, very interesting to see how Powell reacts. Again, I'm sure President Trump will be happy that he got his rate cut finally that he's been saying that he's been wanting for so long now. And we'll just see we'll see what happens. It's really no telling. I think the most important thing to watch out now is how his tone is going forward on rate cuts ahead. Because if this is the only rate cut, then that's, it's already probably priced in. I mean, the market went up, went down. The market realistically hasn't moved since the news of the rate cut. Just been volatile, but it really hasn't moved pretty much at all. Because, I mean, it really has been priced in. And just to take into context, the market has been pushing up since this April 4th low for, 5, nearly 6 months now. And just making higher lows. Uptrend is still definitely intact, but at the same time, you have to wonder if the market wants to pull back anytime soon. So, it's interesting. If we pull up the turtle trading strategy, this is a, pretty common, at least it was common. It's a trend following strategy. So basically what this means is until the trend followers get out, a lot of the institutions and CTAs are going to remain long equities. And basically what trend followers do is they buy in these uptrends. You can see they bought right here when the price broke over this 20-day or 55-day high. And they've just been holding ever since. And their exit will be right here or on the stop loss. And so until we get, to the trend follower stop loss, all these CTAs are pretty much max long I've been seeing on X and can continue pushing equities higher. So we'll have to get some sort of news going forward to really trigger, a sell-off to this level. And then once we get to this level, the trend followers will, get stopped out, sell out of the market. And that's when you can see things start to spiral down. Kind of same thing happened here on SPY on the Turtle Traders indicator. There's a few stop losses, pretty choppy here. 1, 2, 3 stop losses. But when this stop loss hit and then this line got broke, the market just continued trending down. Trend followers did not get back in. So that's something to kind of, watch out for as well. Let's see. Let me take this back off. That was just an interesting kind of tidbit there from the Turtle Traders indicator that we made. Now look at SPY. It's heading right back up. We got Powell's speech coming on live in about 8 minutes. Until then, let's take a look at some of these kind of crazy social takers and see what they're doing. Something I noticed, I don't know if if you guys are on X or Twitter, whatever you call it, you've probably seen Open here. It's been trending like crazy. And I thought this was really interesting. If you look at our RSI divergences indicator towards the bottom of the screen here, you can see this red line indicating a bearish RSI divergence. It started here on this high. And as the price has continued up to make new highs, the RSI made a lower high, indicating that there's a bearish divergence. So, I mean, I'm not trading Open, but if you are, that's something cool to look out for. And this RSI divergence indicator is available for free on the TrendSpider store. If you guys haven't heard of it, by the way, our TrendSpider store is awesome. There's like hundreds of indicators and scanners and all this crazy stuff. I just dropped a link in the chat for you guys to check it out. But yeah, if you guys are looking for some new indicators or scans or some ideas, strategies, take a look in there. There's lots of stuff in there for you guys to import for free. And again, if you guys are just tuning in or new to this channel, please go ahead and hit that subscribe button and hit like. Would really appreciate it. As we come in here to watch Powell speak in about 6 minutes now. 6 minutes till Powell speaks. So this is going to be, again, the real market mover, you guys. We're going to see exactly what Powell has to say about the markets, or really interest rates, and what they mean going forward. And something else that I wanted to pull up was the dot plot. Let me pull up the official Fed calendar here. So I'm curious to see myself even what the dot plot is looking like. And of course, the first result on Google is outdated. They should have dropped it by now. Yeah, it's not popping up yet. Maybe go to the Federal Reserve calendar. I'm just curious to see what is going on there on the dot plot, because it will be very important, especially as we head into this speech here. Maybe I can show you guys real quick. Let me pull up this SPY chart again. But yeah, SPY is just, again, it's actually up a little bit since the first candle right here. It's actually exactly at the first candle where it started. So we practically have not moved, guys. We just went up, down, right back up to the middle. This is classic, just markets and mean reversion and volatility. And again, I think that's because everybody's waiting for Powell's to speak right now. And of course, they changed their calendar. September PDF. I have finally found it. So we have just a few minutes. And until then, let me go ahead and show you guys the dot plot. This is the dot plot right here. So you can see 2025, it's by year, 2025 to 2028 in the longer run. In 2025, they're expecting the rates to be maybe above 4, but as you can see right here, in 2026 and so forth, they're expecting the rates to be all under 4, which is pretty interesting. Just wanted to show you guys that real quick. If you guys want to take a look, I'll drop the link to that in the chart below, or I mean in the chat below. But yeah, clearly they're looking for it to be pretty much under 4% in the longer run as far as rates go, which means there's really no chance of them, at least in the current state, doing any future rate cuts or really alluding to it at all, which is pretty important context to know as we go in and hear Powell speak. I pull up the EFFR again right here. I don't think it'll be updated yet because it literally just happened. But yeah, we're at 4.25 to 4.5, which means a 25 basis point cut will bring us at 4 to 4.25. So the rates are pretty much like, 4.125% or whatever it is now in the middle. And for the longer run, these Fed officials that voted in the dot plot are expecting it to be lower than 4%. So expect, from what the Fed is saying, rate cuts, probably more of them in 2026, maybe just like a small rate cut, 1 to 2. But again, that'll change as, markets change, as the economy changes going forward. That is just their projections now. All right. And as we come into the meeting, we got 2 minutes. We are seeing SPY actually have some pretty bullish momentum right now. Volume has been kind of declining. I don't know. It's been really high. Volume was pretty dead all throughout the day, obviously, until now. And look at that. SPY is having a nice little comeback off the low here, about 0.39%. Let's check out some, more volatile stocks like AMD coming up, NVIDIA coming up. IWM is probably on a tear. From the low, IWM is up almost 1%. Nothing insane. What else do we got here on our list? IONQ. This is a stock that has been breaking out lately as well. Look at this nice base. Almost sort of like a VCP, not making those higher lows, but very high volume breakout in IONQ. Let's go back here to QQQ maybe and see what the Qs are up to. From the low, Q is up, I don't know, 0.5%. It's pretty nice there, pretty nice. And in about 1 minute, you guys, the speech should be starting. So expect some volatile movement here in the next few minutes for sure. If you guys are in trades, be wary of that because things might start to get wild. Usually it does the second we see Powell pop up on stage. Here we go. The screen just ticked on. Let me go ahead and turn on the volume. Like we got some music playing. And any second now, I think Mr. Powell is going to walk out that door and send the markets doing something. Let's find out. Let's find out. There he is. Powell just took the stage, everybody.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick quick follow. I'm sorry. Can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And, you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmerosa, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward.
Yeah, so Powell's just saying right now, sorry to interrupt, that
goals, and that suggests that
they're able to keep the rates, he said restrictive, which is what the rates were at, like 4.25 to 4.5, because the labor market looks good, but now that it's not looking very good, these layoffs, not a lot of hiring going on, this week they decided to cut.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting. And now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year. and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
Like a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who is at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a really great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together and we see that the labor market is softening and we don't need it to soften anymore, don't want it to. So we use our tools and, it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic. Of course, goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants, of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side,
why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy is growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and, business investment. So we watch all of it. And I would say we did move up the median for growth for this year, actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape. Banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations, both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals. And so we have to balance those two. When they're both at risk, we have to balance them. And that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right. Well, that is the end of FOMC. Close that out. So what do you guys think? I was using Sidekick that whole time, or most of the time, to kind of get a kind of clear picture of what was going on. And this is kind of what I got from it. It's one, the reason for the cut is that it's kind of weaker demand in the labor market. And here is what the trap ought to say. He was clearly dovish with the key evidence saying that the labor market is not solid anymore. Cutting rates specifically because the job market is not solid. Labor demand falling. A lot of about employment and labor demand. But he was also saying he doesn't feel the need to move quickly as far as cutting rates goes. So I wouldn't necessarily, it'll be interesting to see what the odds are for a rate cut for the next meeting. I don't know if that's on Polymarket yet. We can actually take a quick look. Yeah, it is. Oh, interesting. Let me pull this up for you guys. I think it's pricing in a pretty solid chance of another rate cut. This might be already updated on here. Fed decision in September just happened. Obviously, we got the rate cut. So let me put on the custom indicator so I can paste in the new link. Now look at this, you guys. October. Fed decision in October. October 29th, I believe, is the next one, according to Polymarket here. We're seeing a very high chance of another rate cut. Very, very interesting. I wonder if that moved at all today. Actually jumped up. So potentially another rate cut coming up, you guys, in October. At least that's what the market is pricing in now. Yeah, thank you, everybody, for showing up. I know somebody out there is asking me for the turtle trader indicator on AMAT. It looks like it just entered here yesterday on the 16th. It back tested okay, nothing insane. But yeah, it did just enter. It's pulling up into this gap right here, so it should be interesting there. It's a system one entry. I believe that is a 20-day high. The ATR stop looks like it's right around that like 167 or so. So yeah. Is there any other questions that you guys had? Let me pull up the Sidekick, make sure I didn't miss anything. Oh, but Sidekick was saying near-term positive, or in the near term for the next 3 to 6 months. Could see a potential boost in equities, but then medium-term risk is that, since they're cutting rates, that's obviously he's saying the labor market is not looking good. So if the labor market continues to not look good, that can take an effect on the market over the long run. So definitely keep an eye on unemployment and the labor market. That seems to be what Powell was talking about the most. So I would, really keep an eye on the labor market, unemployment rate, stuff like that, to see signs of how the economy is doing. But if you guys are still out here, please hit the subscribe button and like and turn on the notification bell. Follow us on X so that way you guys can always be alerted when we go live, because we do tend to go live for a lot of these big events. And would love to have you guys here. They're completely free to join, of course. And you get some free analysis on the TrendSpider platform and Sidekick and all the awesome stuff that we offer. ATR means stop all. The ATR stop is just, it's one of the stop losses. So whichever exit it hit first will be your exit. So if it does hit that ATR stop, that is technically, yes, your exit. But if you look into the settings right here, it's a system one entry, which is a 20-day high. A system one exit is a 10-day low. And that line should start painting. It's actually the same as the purple line. So your first stop should be this magenta line at 167.45. And then, this 10-day low line will move up over time. But currently, your stop loss, it's technically both lines. But currently, the highest one is the stop loss. Let's see. Open up BABA here, see how the China equities are doing. Wow, BABA has been taking off. have not really been watching BABA. Look at that. It's been basing up for quite a while now, and it's currently ripping up higher. So yeah, definitely keep a look on Chinese stocks. That is quite interesting. But yeah, anyways, guys, that's going to do it. Hit the subscribe button if you aren't subscribed already. We've been live for over an hour and a half now, so we're going to call it there. Thank you guys all for showing up, and I'll catch you guys in the next one. Peace.